We recommend a sell on Cathay Bank with a 37% downside. The stock is at all-time highs, while management is guiding for growth and profitability that hasn't been seen in years. Our view is different.
Cathay's been around since the 60s, when waves of Asian immigrants with language barriers needed access to financial services that mainstream banks either couldn't or wouldn't offer. Over the next 6 decades, the company scaled alongside their niche, and today, they're the second largest Asian American bank. They sit across 9 different states with over 60 branches, primarily on the West Coast.
Now, banks make money in two ways. First, spread. You borrow cheap, lend at a higher rate, and pocket the difference. They drive over 90% of their total income. The rest come from services like wealth management, which generates fees.
And these fees are a better business. They're stable, recurring, but they're harder to scale. This means that Cathay depends solely on their balance sheet, and one bad loan can wipe out 9 good ones. So banks are required to set aside reserves for them, which comes directly out of earnings. So, more defaults, more reserves, lower profits.
And on top of that, banking is a very competitive business. Smaller banks fight for the same clients as the multinationals. Here we met 80 banks across street expectations for returns on equity and deposit growth. Further a bank is to the top right, the better. Wall Street places Cathay near the middle, expecting mid-teen returns while growing their franchise by over 4%. We see it differently.
Wall Street is ignoring Cathay's rising costs and fading moat. Language used to be Cathay's edge, but they over-relied on it for years rather than reinvesting. Today, customers are demanding more, and Cathay faces a slowing franchise with one of the highest funding costs in America. So, to address this, they're pivoting into commercial and industrial lending, otherwise known as C&I. But this will require millions in additional expenses and take far longer than Wall Street anticipates. Finally, the credit stress is rising while reserves sit well below peers. All in, you're looking at expectations that seem drastically overstated.
But why doesn't the street see this? For one, Cathay is covered by fewer than 5 analysts. And with low trading volume, that translates into less analyst focus, where earnings calls pass without questions being asked, and they're cornered into accepting management guidance and macro trends. And after 60 years of stability, there's little reason to go against the narrative. But our team, we've dove deeper with hundreds of hours of due diligence to develop a clear edge. We interviewed 5 executives of Cathay's peers, including a president, a CFO, and 2 heads of risk. Then also a head of cross-border banking and former president of a Chinese bank. Then we traveled to Chinatown and interviewed 6 business clients of Cathay and 2 management consulting firms. Finally, we supplemented this with grassroots research, analyzing thousands of Glassdoor and Google reviews, alongside over 25 years of financial filings. Now, here is what we found.
Since 2001, Cathay's lost 25% of its Asian market share. This market once grew at 13%, and Cathay rode this wave with its own demographic expanding by 20 times. But that tailwind has faded, with growth decelerating by over 60%. And what's interesting is that Cathay's growth once tracked immigration trends almost perfectly. But as it peaked, so did the bank. Peers, however, were better positioned. The head of cross-border banking at a competitor told us that the industry needed to evolve beyond first-generation clients. While competitors invested and adapted, Cathay didn't.
And you can see this in their performance. Before the GFC, Cathay was a best-in-class bank, generating over 20% in returns on equity and 4% in margins. But since, they never quite recovered, with returns on equity down 40%. One reason is that they spent decades training their clients to demand higher rates. And today, they have one of the cost of fundings in America. One reason, the CFO at a major competitor told us that these expectations make it harder for them to shift into cheaper funding. This will continue to pressure margins going forward. So, with returns under pressure, Cathay is now chasing C&I clients whose business accounts bring higher yields and lower costs.
Before 2009, Cathay and its biggest competitor, East West, traded identically. But then the GFC came and East West acquired the collapsing United Commercial Bank. This gave them access to a rare Chinese banking license that became their biggest edge, as it allowed them to provide better cross border services and become the preferred bank for Asian CNI clients.
But China, they haven't issued a license in decades, and with current tensions, the odds of them doing so are very low. As a result, Cathay is left to fight for domestic CNI lending, which is as competitive as it's ever been.
Private credit now dominates middle market lending, with a market share that has nearly doubled since 2010. The president of one of California's largest banks told us that it's a major disruptor.
So, to succeed, Cathay will need to originate $1.5 billion in CNI loans. But this will require them to fully revamp their tech infrastructure and services to remain competitive.
Cathay's current efficiency ratio is among the best in the industry, given that they underinvested for decades. But we believe that hiring new CNI bankers, rebuilding their back office, and revamping their tech stack will push them over 50% by 2030.
And they're attempting this strategy pivot at a time when their loan book is showing serious stress. Criticized and special mention loans have been climbing for 6 consecutive quarters. And the ratio of stressed loans is now more than double that of its Asian peers, which are the most conservative lenders in America.
Right, Sam. And this reserves also nearly half of those peers. This is counterintuitive. Deteriorating credit should mean higher reserves, not lower.
But ultimately, banking is a people's business. In environmental, we rank them the highest, differentiating themselves by their superior focus on clean energy. In social, we recognize the initiatives they're taking to invest in low-income housing projects. However, when looking at every Glassdoor review, we see that they have the lowest CEO approval and employee satisfaction ratings. Therefore, we rank them the lowest.
But governance, that's where we're most concerned. Cathay's incentive structure heavily promotes EPS growth over credit quality, which to us explains their stress loan book. Therefore, we scored them a 2.8 as we believe that they're misaligned. Now, we implemented all 3 ESG pillars into our model. Their focus on clean energy and low-income housing lowered their tax rate. Their low culture scores drove above-market hiring costs. And finally, their misaligned incentive structure justified sustained credit stress.
Now, everything we've shown you today translates into one metric: returns on tangible equity. Workers are 13% and betting record margin expansion, strong loan growth, and benign credit. By applying our 3 theses, such as franchise erosion, CNI build-out costs, and credit normalization, and you arrive at 10.8% with lower margins, slower growth, and higher costs.
And you can see how this better translates in our 2027 variance analysis. The gaps in NII, expenses, and provisions lands at a median 22% shortfall in profits. And our regression quantifies that gap in market terms, landing at a 30% downside.
But ultimately, every business is worth the present value of its cash flows. For banks, this means discounting dividends and residual income because they link a bank's ability to compound capital over time to its valuation. The intuition is simple. As a bank generates excellent returns above and beyond its cost of equity, it should command a higher premium. For Cathay, however, this ability is quickly deteriorating. At today's price, Wall Street is implying otherwise.
We see 3 risks. First, reserve discretion. Management can delay adjustments to inflate earnings, but deferring these provisions only magnifies the eventual hit.
Second, M&A. While a merger could improve their mix, targets today are trading at dilutive premiums and carry heavy integration risks. Conversely, they could also be acquired, but buyers are looking for better deposit and loan mixes.
Finally, deregulation could ease capital constraints, but historically, Asian-focused peers have operated comfortably with these high ratios. So even in the event of a constraint easing, Cathay's unlikely to come down from these high levels.
We took all 5 valuation methods and weighted them equally to avoid over-reliance on any single framework. This includes our dividend discount model, residual income model, and 3 market-based approaches. Now, the logic and the thinking behind our weighting lies in our assessments of risk and reward. By embedding 3 market-based approaches, we ensure that our price target clearly reflects the risk to our thesis, which still lays a meaningful 37% downside.
Look, Cathay's 60-year legacy is undeniable, but a bank's history should not be the sole driver of its valuation. With its fading moat, rising costs, and mounting credit stress, the margin of safety is gone. Thank you, and with that, we'll be happy to take any questions.
Thank you for your presentation. It was very good. My question is on your expectations against Wall Street's expectations. You seem to differ quite considerably. I was wondering how previous Wall Street estimates have compared to the actual results of the company. Has the variance also been significant historically?
Thank you for your question. Eamon, why don't we go to the security sale?
Security sales.
So just to answer the question very briefly, they mostly met expectations. There are a few slight misses here and there, but nothing too drastic. But let's look at the latest sort of three quarters. 4 years, Cathay had really sold securities. So for banks, you have a portfolio of securities on your balance sheet. And if you sell some, this is accretive to your EPS. So you have to be really careful when you look at earnings per share growth for banks because there's a lot of management discretion that goes into it. If we look at the latest 2 quarters, they barely beat expectations, and most of it came from them increasing their sales of security and what's most concerning to us, decreasing the levels of provisions. Remember, when banks have to set reserves to those loans that could go bad, this is what we call provision. So as soon as you increase provisions, this decreases the amount of EPS. They've been releasing provisions at a time where the credit has been getting worse to beat earnings. If they wouldn't have done these two things, they would have missed earnings meaningfully by almost 10, 15%. So that's what we're concerned, sort of in the decision that management is making today. Thank you.
Can you explain more fully the fact that they don't have a Chinese license and why that impacts their business and why that makes it harder for them to get C&I loans?
Yeah, absolutely. So, could you go to slide 56, please? So, without this Chinese banking license, ultimately, what this means for Cathay is that they aren't able to have an independent subsidiary within China, and so without this license, they're essentially missing out on those Asian CNI clients and the ability to fully service their domestic clients who still do those daily transactions back to mainland China. So again, in our conversations with the head of cross-border banking at a competitor, he mentioned that without this license, or that with this license, this bank is able to better service their Asian CNI clients because they don't have that operational friction through a third-party subsidiary that Cathay does face. So with these Asian CNI clients, they're able to directly transfer money between China and the US, especially considering the regulation within China.
So why is this such a big deal? Remember, before 2009, Cathay and East West were essentially the same bank. They're traded 1-for-1. But after United Commercial Bank collapsed, which at the time was the largest Asian American bank, East West outperformed Cathay nearly 3 times. So think of the American banking license as a flywheel effect that the more better services you can provide for your Asian clients, the more it's going to entice them to come to you versus Cathay, the better fee income you can have. Remember, Cathay's fee income as percentage of total income is barely 9%. East West is at roughly 15% and almost triple on an absolute basis that of Cathay. So it is a big, big advantage that East West has it and Cathay does.
Can we go on the slide on the valuations where you have the price earnings multiple and
Sorry, which slide are we on?
valuations?
Valuations.
Yeah.
So main deck. Got it.
The football field or the...
Yeah.
Oh, the football field. Gotcha.
Okay. In terms of valuation, I don't see what's that price earning ratio have you calculated for the stock?
Say that one more time.
Price earnings.
Price to earnings right now is at 11 times.
So with a price earning of 11, don't you think that the price is justified? You are saying the price target is 36, if I remember correctly,
Yes.
right? that means that the valuation will go down by about 30% with the price earning multiple of 7 to 8. And why would it go to 7 or 8 multiple despite profitability and despite stable operations?
That is a great question. And when you're looking at bank, it's sort of a two-sided question. You have the price to tangible book value, which is ultimately what we believe, and most of the market seems to believe matters the most. And then you have the price to earnings. Remember, earnings for banks are very hard to look at because it's really up to management discretion in a lot of the little things they could do. Tangible book growth is really hard to replicate. So here we have sort of our three theses laid down on all the different sort of theses, right? So when you're trying to grow price to tangible book value, it's just not enough by growing earnings. You could grow earnings by buying back shares, which decreases the amount of capital, decreases tangible book. So in the long run, as investors, you really want to see bank compounded. So Cathay right now at 1.3, almost 1.4 times is expensive, especially if you believe that they're going to have to spend more. Why don't we show the efficiency relation, perhaps? I really want to talk about the CNI strategy because it is critical to understand this investment. Cathay's been roughly a 50% CRE, private residential mortgages. So roughly 80% of Cathay's expertise is real estate. CNI is a completely different animal. And you have to spend money to go into the strategy in something they've never done before. So they told us roughly 2 years ago that they're going to execute this strategy. And what does this mean? Per the CEO, you have to spend more money to hire more bankers. Just rebuild the bank. What they've done is completely different. This is Cathay's efficiency ratio. It essentially measures the percentage of total cost to total revenues. So the lower, the better. They've been decreasing their efficiency ratio, which looks great for price to earnings, right? More to justify a higher multiple, but doesn't really is conducive of them originating more loans and growing tangible book value, which is ultimately what matters in this thesis.
I have a question on the valuation. Why did you opt to equal weight all the methods? Wouldn't it have made a bit more sense to then have a higher weighting on the valuation method that is more appropriate towards the bank?
Yes. Let's take the first part. Why did we do 5? Why did we weight them equally? It really comes down to our assessment of risk and reward, right? So the price of a bank or any company will always lay it into the downside and upside case. And if we sort of skew to price targets that will give you more downside just to show more downside, that's not really conducive of how a bank or a company will trade in real life because it lies in the whole picture. But how we did it is we took 5 methods, weighted them equally, so at 20% each, but 3 of them are optimistic market-based approaches. So really, it's more skewed to the upside in our case, which still laid that 37% downside because we want that margin of safety, right? It's very impossible to lie to a specific number of what the share price will be, but if you have a significant enough margin, you can feel comfortable making a decision. Now, for your second question, and what do we think is the best approach to evaluate a bank? When we talk to bank investors and people in the industry, we're really looking at that relationship of next 12 months, 2 years, returns on common equity versus the price to tangible book value. So the more ability a bank has to create excess returns above the cost of equity, the higher that price to tangible book value has to be. So if you can think of this line, if you're at the bottom, you kind of achieve for the amount of returns on equity that you're compounding. If you're higher, you're more so on the expensive side. So the way to that's how kind of banks look about bank investors look about it. So if there is a divergence in return on equity, so Walter at 13%, we're at 10.8%, that divergence is enough to justify a lower multiple, which is around 1.1.
I see that you are forecasting Fed cutting cycle and the NIM compressing. So if the outcome is opposite and the rates are sticky and we have a steeper curve, will your thesis one get worse or get better? And what do you think will dominate?
That's a great question and very important point to understand banks as well. So, Iman, would you mind going to the interest rate sensitivity slide? So this is from their own 10K, and this basically assumes a parallel shift in the yield curve. Obviously, that's not what always happens in the real life. But if the interest rates were to shift down 100 basis points, in a parallel way, that would mean that the net interest margin would expand. Now, just like you said, of course, the rates don't always go parallelly. And lately, what we're seeing was a steepening yield curve. That is very good, and it creates a tailwind for the bank because the deposits are usually tied to the short end of the yield curve. And when the yield curve steepens by the short end coming down, that actually allows them to actually lower their deposit costs. But even though there is this recent trend about Fed, cutting cycle, and potentially maybe we have a new Fed chair that is more willing to cut the rates, that only creates short-term effects. Now, in terms of the longer-term valuations, Matteo, would you like to delve deeper into how that affects it?
The reason this bank really is trading at all-time highs is because NIM has expanded. We are modeling a NIM expansion ourselves. We believe this bank should benefit from the rate environment and continue to expand NIM. But it is only one part of valuation, right? So APS, return on tangible equity. The other part is what do you have to spend? We already established to have a big gap in reinvestment. So even with NIM expansion, taking up non-interest expenses by over 5% versus Wall Street every single year is enough to decrease returns on equity by almost 200 basis points. So that's kind of where the big difference comes from. And again, going back to margin of safety, by modeling that NIM expansion that Wall Street expects, we can clearly pinpoint where is our variance coming from Wall Street. And then it becomes an exercise where it's more art than a science, and you're really thinking critically about this bank's business model going forward.
Speaking of the business model, so if you don't like them going after C&I loans, is there some other strategy that you would recommend for the bank?
I think that's an excellent question and a great place of clarification. So we actually do like their pivot into C&I. It makes a lot of sense. It increases their high yielding loans. It also decreases their cost of funding. The issue with that is within the expectations and how they're not aligning their strategy with execution. We understand after our conversations with professionals in the businesses, CFOs who've already built out this model in the past, just a decade ago, they have their own personal experience. They told us it takes like 5 years in order to build out this strategy. They need to hire, they need to invest in their technology, but Cathay isn't doing that. We've showed this. Their efficiency ratio is on a steady decline. They're not investing into the business, and this is going to take them out of their competition.
And it has translated into very benign C&I loan growth. I believe year over year is only 1%. East West, its biggest competitor, is growing C&I by roughly 12%. So, yeah, C&I makes the most sense, and it's likely their only option at this point, but they're not executing it in a way that's conducive for loan growth. And Wall Street is rewarding them for something that hasn't materialized yet, and it would take over 5 years. So, again, I guess a good way to think about it is you have to take 2 steps back before you can move forward. C&I lending is the most competitive lending sector in America. Remember, private credit, East West Bank, all the big commercial banks, right? It's really hard to originate C&I loans. And Sam, what was the thing that the president of one of California's largest banks told us about C&I?
So he told us, the president, he told us that
The more competitive.
also
Might be harder. You might
private.
So basically, one of largest banks president told us and made us the analogy that if you want to go into CNI lending, it's a different strategy. So, Eamon, for example, do you mind if we show the loan book that Cathay has?
Yes.
So Cathay is about 80% real estate focused bank, but they want to go into the CNI segment and expand that. But when we talk with the people and executives who already successfully executed the strategy, they told us that, he made the analogy that regular CRE bankers are like general surgeons. But if you want CNI bankers, they are like neurosurgeons. They are very precise, have a different skill set, and command higher compensation.
What does this mean? Higher cost, lower EPS, lower returns on equity.
Do you have the relative valuation somewhere and the price performance of the stock for the last 2-3 years?
The dilution on the stock price
Yeah.
or the performance of the stock price?
No, valuation compared to competitors in terms of price to book or whatever.
Yeah. So
Yeah.
this is kind of how you can see Cathay. The light is a little bit dim here,
Yeah.
but essentially it's been pretty much tracking the banking index, but it has outperformed even its biggest competitor, East West Bank, significantly this past year. I think East West Bank is up maybe 10% year to date. Cathay is what, at 17, almost 20%. It's really outperforming East West because banking analysts are judging a bank that's executing a new, exciting strategy. They're growing EPS on paper through Social Securities and provisions. And they think, okay, maybe by year end, we're going to start seeing C&I results. We had, I think the most overwhelming message we got from the C-suite that we spoke with our competitors is that C&I will take at least 5 years before it starts paying dividends. Wall Street is not seeing that. Thank you.
Thank you so much.